A while ago, I said the train was leaving the station and I asked whether you were on board or not. Now, the train is backed up and it's pausing. It's having mechanical problems. So the big question is, do we resume our trip higher or do we backtrack lower? It reminds me of that old thing when you're a kid that I think I can. But what if the markets can't? What is your plan of action for either scenario, whether it moves higher or whether this was just a mild pullback, it's consolidating the gains before it moves higher, or whether this is actually a break and it can't hold support and it breaks lower? On a related topic, and this is really going to be the soup du jour today. This is really going to be the thing where you want to pay attention. What is the hardest lesson for new CANSLIM investors to learn as an investor? And we're going to talk about breakout stocks and the pros and cons. We're also going to talk about the equity curve, the growth stock investing versus, slightly, like the CANSLIM versus kind of how Revere does it. It's slightly different. Okay. Then we're going to go to the mailbag. Oh, then we've got 7. And by the way, I've got show notes in the show notes. There's some articles in there. You can certainly read them and go through them. One is about the Social Security estimates being at 3% next year. One, some intriguing Roth IRA mathematics for higher net worth individuals. Here's the problem. You can only put 6,000 or 7,000 a year in, so it's hard to get big amounts in there. But if you can, it's a very interesting article. And then one more, rest in peace, about recession. This article is claiming the recession, it didn't come to fruition. It's over. But now do we have to worry about resurging inflation? And those are all pretty good articles. You can read them and interested. If you got any questions on them, you can reach out and talk to me about those. And then they had an article in the mailbag. It's talking about the 7 types of investments that regular retail investors, don't you love how they classify you as a regular retail investor, should avoid because you're not sophisticated or you should stay away from these. A few of these I disagree with vehemently. A few of these I agree with completely. And a few, it depends on the situation. So anyway, and then we're going to go to the mailbag because, and especially the last mailbag dovetails perfectly with the soup du jour, with the topic at hand. So we're going to get into that. First, I'm going to talk about the 7 types of investments that you as a regular retail investor should avoid. Speculative assets. That's number 1. That's pretty broad. That could even be a growth stock. So a growth stock is Tesla. Should you avoid Tesla? Should you not own that? But anyway, it's basically saying the daunting average person with a financial advisor, they should stay away from anything clear that's considered speculative. I'm saying this is wrong with caveats. If you have a sell discipline, it's okay. If they're highly liquid, it's okay. What I would say, if it's illiquid, if it's some kind of private equity deal and you don't do a lot of due diligence, then I would agree with that. But speculative assets is just too broad for me. That's too broad of a net. Number 2, real estate investment trust. Clients should stay away from real estate investment trusts. They're mutual funds that operate shopping malls, office buildings, apartments, shopping. And here's their argument. And my answer on this is sometimes you should avoid REITs. Other times they're a good investment. But shopping malls are entering foreclosure left and right. As online shopping increases in popularity, office vacancies have soared 17% nationwide. More people are working from home. You know the story. Okay. But now you've got vacancy rates climbing 23%. You've got, it's harder to refinance because rising interest rates and the likelihood of foreclosure. We've talked about this on the show. Commercial mortgages, folks, usually re-up every 5 to 7 years. They're shorter term because commercial leases are 5 or 7 years. It's not like a 30-year mortgage on your house. So they can't lock in a super low rate and hold it for a long time. They've got to refinance, and now they're getting a bunch of refinancing. So what I would say to this on REITs is right now, I would, from a fundamental analysis standpoint, I would be staying away from commercial properties and commercial REITs. But some REITs like residential housing or even the retirement communities that are in high demand, there are certain sectors in there that aren't as risky in this current environment. So the time to stay away from REITs is when they're bad, when they're not doing well, when they're trending down. The time to own REITs is when they're trending higher and they're showing strong relative strength. Penny stocks. Oh, this guy's right on this one. I mean, unless you're just like to go to Vegas, penny stocks are high risk, low price stocks. It's low cost, but it's high upside potential. But however, being highly speculated, it's targets of pump and dump schemes and scammers. This is absolutely true. To lure inexperienced investors to invest in a stock by promoting the stock and then dumping it. Folks, penny stocks are extremely speculative. And for every one that goes up 1,000%, goes up tenfold, you have 9 of them that go belly up and go bankrupt. So to have enough diversification so that one position doesn't cream you, what do? You have to buy 10 of them. So now you hit one that hits a home run, then you have 9 that go bankrupt. You kind of got an average return. It's just better to stick with highly liquid stocks. Okay. Number 5, investments they don't understand. I would agree with this if you don't understand it. Now, we do a lot of technical analysis and we do a lot of stuff that's it's just highly technical, and it would be hard to follow every nuance. But as long as the client understands conceptually the process and the philosophy that you've got some type of sell discipline, you're going to have certain drawdowns, or you're buying on these metrics, you have this allocation. But if you really don't understand the investment, if you don't have a professional that does and is advising you on it, I would stay away from that. Number 6, commodities. Everyday investors should avoid commodities. Everyday investors should avoid commodities. That's too blanket. I don't really like that. He's saying derivatives rather than buying actual commodities. They're actually based on derivatives, and that's there's nuance to trading futures contracts. That is true, and you want to leave the futures to professional traders. I would agree with that. But there are also commodity ETFs that trade on the stock market where you have a commodities trader within the ETF that manages it for you. So you can put that ETF up there with a ticker just like a stock, and you can have rules around that. But commodities specifically, buying commodity futures, that is a little bit tricky. And 7, and I agree with this for the most part, unless you're very high net worth. Number 7, individual muni bonds. He said the retail investor, individual muni bonds, a preferential tax treatment is attractive for those in higher tax brackets. Although he's talking about you get credit downgrades that can adversely affect the bonds. And there's some other issues. Folks, here's the problem with muni bonds, okay? You got to look at the after-tax equivalent yield. So if I can make 5.5 in a short-term treasury or even 5 or 6 in some corporate bond, and I'm getting 2.5 or 3 in a muni bond. I'm just throwing out examples. These are not real numbers. And 2.5 in muni bonds, once I pay the tax on my taxable bond, is that yield higher than the free tax, the tax-free interest on the muni bond? It's called the after-tax equivalent yield. Then you compare apples to apples purely on interest. Now let's look at risk. Muni bonds, their market is small because they're only tax-free for the citizens of that state and other states that don't have an income tax system like Texas, Tennessee, and Florida. So California, it's a pretty big state. If you're California citizens, that's their market, and then plus Texas and these other 5 tax-free states. However, if you're Idaho doesn't have a lot of volume. There's not a lot of volume in Idaho muni bonds, and so you can get caught in a liquidity squeeze later if you ever want to get out. Here's the other thing that happens. An investment advisor will buy $100 million of muni bonds for all their clients. And then they stick 2 bonds in one account, 5 bonds in another. 50 bonds in a larger account. In $1 million bond account, they do 50,000. That's a 5% position. But if that guy needs money, his daughter's getting married, he needs to sell those. Even $50,000 is a very, very small piece, and a bond broker knows that's a distressed sale. And whatever you see on the statement, you're going to get less than that. You're going to take a 3, 4, 5% hickey because those bonds are traded in $1 million blocks. So individual bonds, once they allocate them across the individual accounts, you don't have liquidity there. You're you're at the mercy of the bid-ask spread, or you're going to hold to maturity. Okay, so unless you have a multi-million-dollar account and you're buying big, large blocks of individual bonds, it's better just to use the bond ETF where you can get in and out and just get in and out with a single trade. And that gets a little bit tricky. But anyway, muni bonds are much more complicated than people think. And I would tell you, as a general rule of thumb, as a heuristic, I would say I steer away from muni bonds because I can find other things that after I pay the tax have a higher yield and they're safer and more liquid. That's me. All right. Now, for the main, we got to go to the mailbag. And then we're going to jump right into the main topic. All right. So this was from Thursday, August 10th. Hi, Don. Really enjoyed your videos. The content you put out there is nothing short than amazing. Kudos to Don. That's my comment. I've been trading from 2017, started making money in 2020, had my first down year 2022, around 6%, not too bad. At the moment, I don't have a lot of time to be in the markets with 2 children, the other small children. With the time difference, it's very difficult to prepare them at the markets at 15:30. I have a full-time as well. Being from South Africa, is it possible to become a client? We'll love to hear from you. Regards, JR. JR, baby, from South Africa. My one of my best friends and neighbor, Luther Lingenfelder, is from South Africa. He's a great guy. Anyway, and so Don says, thanks so much for the kind words. I'm copying my partner, Dan Stewart. He will investigate whether we can accept clients from South Africa. Thanks for reaching out. Unfortunately, and alas, we cannot accept clients from South Africa. And if we have existing clients from South Africa, we have to say bye-bye to them because they did not sign we don't have a treaty, the correct treaty with South Africa. Now, if you're international and you're watching this, don't be discouraged. There's lots of countries we can take. Europe, it just depends on the country. Norway, it's all good. Sweden, not so much. Portugal's good, Spain's bad, or is it the other way around? You just have to check. But we do take on international clients, and we do have international clients. So it just depends. Okay. Another one, August 10th. Hi, Don. Is this an opportunity? ? MW. And then he's got a little screenshot he took, and it's an advertisement. It says, want to make $1,000 in 2 weeks, buy 99 shares of J&J stock. Many individual investors are trying to do just that by purchasing 99 shares of J&J stock to take advantage of their odd lot rule in the company's $40 billion exchange with Kevinu. The potential payoff, if things go right, is more than $1,000. $1,000 on what? But however, that isn't guaranteed because it hinges on the near-term stock price of the two companies. The opportunity arises from J&J ticker exchange offer, Reed and Barron's. So I have actually put that link in the show notes. You can actually read the details of it. But I loved Don's answer is very succinct. You know Don, he's like a surgeon. There's no cordiality, just very cut and dry. Hi, M. Nothing is ever a sure thing in the market. That payoff, however, isn't guaranteed because it, quote, hinges on the near-term stock prices of the two companies. I can't predict the outcome. Don. All right. Finally, and this is the one that's going to dovetail with our topic today. This was Tuesday, 8/8. And this is from LS. Pay attention to the initials LS. Should I sell TDMX with their new, they had some negative news, with their bad news, or do you think it will bounce back? Keyword there, think. I still have a profit, but it sounds like they're struggling with the payouts to employees. Thanks, LS. This is me. Jay, I called her Judy. Nice to hear from you. It all depends on your strategy, but we would not be holding now based on its terrible reaction to earnings and or if following a CANSLIM methodology. We never think about what a stock might do, and that simply gets us in trouble. We measure what is happening while it's happening and make adjustments accordingly. Don has been a master at this. Some stocks won't work out, but we will not let a single stock ruin our strategy. So if the stock breaks, it is a sell regardless of what we think or wish. We cannot give you specific stock advice without knowing your cost basis, where you purchased, your other positions, correlations, your other positions in the portfolio. Folks, it's not about any one individual position. It's about the positions in their entirety in the portfolio and their correlations to each other. Anyway, without knowing your cost basis, where you purchase your other positions, your time frame, as well as your trading and investing strategy. Is she short or midterm? What is it? I wish I could be of more help. Best of luck, Dan. Don's answer to me, Dan, your answer is perfect, but you got her name wrong. So I emailed her back and I said, sorry, Linda, I meant to say Judy. I actually had a girlfriend in high school with your same last name. So every time I see your name, last name, I think of Judy. All right. So with that, folks, we are going to...
Memories.
What do you say?
Like the corners of mine. I'm singing memories, Dan.
Yep. Anyway, she was a nice girl, Judy. Anyway, so I started the show with, the train has left the station a month and a half ago, I had this nice rally for a couple months, and now it's pulled back some. And now it's kind of resting, right? And so what's going to happen here is the question. How do you prepare? Because there's only 3 scenarios. One, it just goes sideways. That scenario will not happen for a long time. The other 2 scenarios, one of those is going to happen. I don't know which one. It's either going to consolidate the gains and then resume higher, or it's going to break down and sell off. So the topic I brought up is, what is the hardest lesson for a new CANSLIM investor who's trying to, buy breakouts? That's the CANSLIM methodology, and the pros and cons of that. And then related to that, the equity curve of growth stock investing. And we're going to compare a couple of examples. So with Don, I turn that over to you, Don.
Well, thanks, Dan. So up on my screen, I am showing a chart that has been developed over years of feedback of our process, and when it's in favor and when it's not in favor, and how we react accordingly. And part of this chart is your approach to the market. So let's take, for example, let's review the different types first of all, and where we are right now. We're in bull pullback mode, which is a mild pullback of 3 to 4%. Our expectation for Grotection we should be in line or with minor underperformance, and this is exactly what we've seen. With the S&P down 3%, we were down 4%. We're coming back from bull 1, which is early bull market, which a bear market rally, which is where we came off the bottom, evolved into, and our expectation is at the beginning inline or minor outperformance. We actually saw the minor outperformance, so basically up 2 to 3% versus what the S&P was doing. Now we're giving that back a little bit more. If we hit more than minus 4%, we go into the mild correction mode, and our performance should be in line, or if we get a little bit worse than that, we'll have minor outperformance. In this case, I'm referring to in line with a 60-40 portfolio, because if you correct more than, say, 6%-ish, 5 to 6% in this case, we're going to be under the 50-day moving average, but still above the 100-day moving average on the S&P 500. And our target exposure to the market is going to be about a 0.6. In other words, about 60% in the S&P and the rest in cash. And we'll do that by being in SSO by about 30%. and some possible hedges and some possible opportunities in individual names. But the key column here is the approach to the market during these different expectations. And as long as you're in a bull market, you've got the green light to buy breakouts. They won't be perfect. Some of them will fail. Some hedge fund managers, portfolio managers, endowments will take that opportunity of new highs to take some off the table, and sometimes that will overwhelm the demand for the stock. And even in the best of conditions, it's about a 50-50 shot with whether or not a breakout is going to work. But the payoff and the O'Neill approach is that you can lose 7% three times, and you gain 120%, that offsets it. So uh, with a 50-50 batting average, you should clearly be able to make money with these types of with this approach in markets. The problem is when this pullback starts, and you can't recognize it quickly enough to stop buying breakouts. They should definitely be taken with a dose of caution. And as it appears that we're migrating in more from this mild pullback to this mild correction, and breakouts just aren't going to work. They just don't work. But the IBD methodology is, for the most part, geared toward looking for setups and buy the breakout. And plain and simple, and this is from years of experience, and anybody that knows CANSLIM knows that the most important letter in CANSLIM is the M in market, but it's not always cut and dried whether or not it's a buy or a sell. There are 1,000 shades of gray in there between how strong the market is, which sectors are in favor, what the market's preferring. So we avoid breakouts. The only type of strength that we will buy in a market like this is off of a support level, a pullback to a moving average. In other words, you want to, the next column, buy pullbacks. And in any of these situations, whether or not you're in a mild pullback or a mild correction or a bear market, buying pullbacks is certainly a low risk way to get entry into the market with a tight stop that should be right below where you're buying. It's either going to work or the market's going to worsen, and you're going to break that support level that you're buying off of. If you go into this moderate correction, buying pullbacks is certainly cautionary, and anything worse than this, you want to get the heck out of the way. You can see over here BMR, which is a bear market rally, early recovery, which we experienced earlier this year. Buying breakouts at best is cautionary. For one reason, there's not going to be a whole lot of them, and you're coming right off the bottom, and the market's not convinced that you're actually, the bottom may be in. So a lot of the fund managers, again, take the opportunity to unload stocks as they look at breaking out through a certain level. But again, buying pullbacks in an early bull market recovery is something that we do all the time. And again, the same situation, it's a low risk entry point. Your stop should be very close to where you're getting in because you're bouncing off of a support level. This third column here is, do you want to short breakdowns or short into resistance? Really no reason to do that when you're in a bull market. You're swimming upstream if you're trying to short in a bull market. You certainly can do it during a pullback because there will be some stocks that are just going to roll over, but it's certainly a cautionary tale. And then shorting breakdowns, our prefer is to short them into resistance, not as they break down. But you got the green light to do that if you want to do it. So basically, over the years that I've been managing and knowing how Grotection and how really CANSLIM will operate versus the S&P 500, this is the chart that we've come up with to identify different types of markets and the way you should trade those different types of markets. So there's a lot of blood, sweat, and tears that went into generating this. And it's good to know what your expectation should be during these different periods. Now, during this pullback, correction, moderate correction, we, for the most part, won't be in individual names. We'll be letting the S&P 500 sort out how low it's going to go. We don't want to be completely out of the market because those first couple of days and that follow-through data you'll get, the indices will be up like 1.5%, 2.5%. And if we can catch that bounce off the bottom and it happens at a very logical area, say the 100-day moving average or a horizontal support line, it's a good low risk way to get money in, either buying a pullback with caution or going into the index that's showing the strength off of the support level. So that's kind of the summary and how we approach things.
Well,
And
let's
Dan, I'm sure you have some questions or comments
well,
based
yeah.
on that.
So what Don did there is very apropos. So the bottom line is, you got to measure the market first. You got to know which direction the market is. Are you in a primary uptrend or are you in a downtrend? Is the market weak or strong? If the market's strong, you can buy breakouts. If the market's weakening, it's tenuous in a strong pullback or bear market, you don't even buy pullbacks. In fact, you ought to be primarily in cash. I think the only thing that I would like to comment is on your chart there. I think it's very clear on when we're in a strong bull market and a bull market, and off the very bottom will always underperform because that's how we missed out and missed a lot of the pain. Missed half or more of the pain on the way down is by being in cash. So when it first bounces off the bottom, because nobody knows where the bottom is, you're always going to underperform. The ones where you have a minor correction or a moderate correction, those are the ones that are, in my opinion, just a little less indeterminate and harder to measure, because the range, it really depends on the range. And that's what he's measuring there. The range is what he's talking about with moderate moderate and what is that next one? Early, the various pullbacks. All right, so let's switch gears now, and let's talk about the CANSLIM specifically and the equity curve, by like how Revere does it, because we kind of have a sell discipline, so we try to smooth it out a little bit. Because, folks, here's the bottom line. If you're just going to buy and hold, and especially if you're going to buy and hold growth stocks, you're going to have to deal with some very, very wide, big swings. And even if you say you're very aggressive, you're an aggressive investor and you've got a aggressive risk profile, when you lose 35%, because that's going to happen every 3, 4, 5, 6 years, you're going to end up hitting your pain threshold, and you're going to sell. You're not going to be able to stand it out. But the whole point is, with Revere, we try to smooth that out a little bit. So we're not trying to absolutely hit a home run and make it 20% returns every year. We're trying to make equity-like returns and decent, good, solid returns without big, major drawdowns that the markets go through every 4 to 5 years. So a perfect example, I guess it's more would be called the extreme example, would be like the ARK funds, the AARK. In 2020, that thing was up huge. But then in 2022, it got absolutely slaughtered. So that thing is going up 40, 50, 80, 90, 100%, then it's losing 60, 70, 80%. Most people can't deal with that kind of volatility. Now, that's the most extreme because they're doing very high beta growth stocks and crypto and all kinds of stuff, right? But even more traditional CANSLIM methodology, if you're constantly doing it and you're all in all the time, your equity curve gets much more volatile. So Don, with that, talk just a little bit about the equity curve.
Yeah, what I'm gonna show is, first of all, the ARKK, the ETF, the Kathy Woods ETF that invests not necessarily in CANSLIM stocks, but in extreme high growth stocks.
Right,
She's
right.
will take some of the more speculative ones, and you can see, very clearly the massive outperformance that she had in 2020, and then it went sideways and built a base throughout 2021. Note the relative strength during this period was lagging because growth stocks were not having a good time relative to the S&P 500. And then when the bear market comes up, just an absolute waterfall to the downside because these speculative names just don't do well. It makes no sense whatsoever to give up this big gain by holding ARKK uh, as it rolls over and goes to the downside. And I've seen people mock FFTY, which is the IBD 50. You can see the big gains that it had during 2020. You can see it building a base here during 2021. Attempted breakout, failed breakout, and then people say, yeah, but look what the FFTY did during 2020. Well, they don't go to cash in FFTY. They will keep their 50 leaders on there with the expectation that if you're following the rules, you're going to sell in this area because we don't hold growth stocks during bear markets. So anybody mocking the performance of FFTY is missing the M in CANSLIM, that you won't even be in the market because the market's not in your favor. We buy when the wind is at our back, not when the wind is at our face. You can pretty much ignore the performance of 50/50 or just use it as a barometer that's telling you, yeah, you're going to get your butt kicked if you hold FFTY during a downtrend, but that's not a surprise to anybody. The average growth stock corrects 72% off of its peak after it tops. We know, and anybody that's read the book and follows the system knows, you're not going to be holding FFTY during this period. You're going to be looking for this period with the bottom being put in. It'll form a cup and handle or a flat base. It'll break out and start going higher. But these couple of bars over here will pretty much tell you what's going on with growth stocks. The RG8 that we show the performance of every day is our way of monitoring what's going on in the growth stock environment. We show that in every video, and it's absolutely growth stocks have not been in favor over the past 4 weeks. You can see ARKK, you can see any of the RG8 is going to tell you that if you look at the chart on it. But it's very difficult to identify on an individual basis what's going on if you're not don't have your finger on the pulse of the market. But when these moving average levels break in leaders, a good example is SMC. We held this during a good part of this ride up. We took profits as it got ridiculously extended. We were down to a 1% position when they reported earnings, and this week it's down 24% as they blew up on earnings. Let's go to a daily chart. And this is one of the quintessential growth names that you should have had if you're an O'Neill investor, an IBD investor, you should have had a position in this, riding this from the breakout here or the gap up here or the breakout above this level. And really didn't give any sell signals, but we do a combination of selling into strength when we get a certain ATR extended from the 21-day moving average, which is this green line. And you can see how ridiculously extended this got all throughout this period. So we were selling into it, waiting to see what happens. And certainly willing to buy it back if it had a good earnings reaction, but it didn't. And we sold our last piece after hours at 303 after the gap down happened. And you can see what's happened this week with SMCI. Not only did it gap down, it made a lower low after the gap down day. And that, if you felt like you were going to be holding it, that's absolutely the final sell signal. We know a high volume break of the 50-day moving average is a typical CANSLIM exit point. So, what goes up must come down at some point, and you can't just hold these things forever. You got to be cognizant of earnings, what's going on in the overall market environment, and what's going on with the individual stock relative to what's going on in the market. The last of these big leaders that we're holding on to is NVIDIA. Our first 3 buys were done before this big move up. This week we've done 2 sells of what we bought post gap up move. The last was yesterday where we locked in our 20% gains, but we've got a big decision to make here. This is looking like it's going to close by under the 50-day moving average at the end of the week. And if we go to a weekly chart, you can see the volume's not overwhelming. So, and 400 is a big support level. So the question is, do we give it a little bit more room? or do we cut some more off? I would say that with the 3 buys that we've done, we would probably take about a third off, as our gains that were up in the 70+% level are down to 50% gain. So this is a big leader. It was the number one stock in the market. It's the one that really put the spotlight on AI with its big gap up and its big projections for the current quarter. But it looks like it's gotten a little late in the process. Anybody that bought in here after the big gap up has seen their profits from where it topped around the 500 level down to 400. If you didn't buy anybody that bought around this level is just getting back to even, and 400 was a big level where people bought, and your profits have been dwindling away. So this is a reason why people are hitting the exits over the last week or so, is that you've seen your profits dissipate. And if you bought it back here, that's great. If you bought it here earlier in the year, you've got plenty of gains to sit through a situation like this, but not necessarily if you bought it late. And you can see the next level here, the 20-week EMA, that's another 10-12% down. So are you willing to give it that much if you close below the 10-week moving average this week? That's a decision that every individual investor has to make, but and we'll be making it by the end of the day today.
So I wanted
depending on how this closes.
I wanted to ask one question going back to the 50-50, right, and the CANSLIM. So CANSLIM, the very first thing you do is you measure the market, and are you in an uptrend or downtrend? So if you're in a downtrend, that would tell, especially if it's very strong, that would tell you don't buy growth stocks. You stop buying growth stocks, right? Now,
yes, unless you want to take small positions on a pullback.
Unless you're taking very, very small positions, you adjust it, right. But right. You're saying that the 50-50 CANSLIM ETF that's theoretically...
FFTY.
FFTY,
right?
Excuse me.
You were talking about...
I'm sorry. Yeah, FFTY, they actually have to they've got to be fully invested at all times. So even though they're marketing themselves as kind of a CANSLIM methodology, they're missing the biggest part of it, and that's why they have the big drawdowns similar to ARK, and they don't actually exhibit true CANSLIM-like results.
Yeah, all this does is it gives you the feedback that you shouldn't be buying growth stocks, which is part of the entire process, the M in market. And if you did stay in them, even though these are the quote unquote leading stocks, this is what you can expect to get in a bear market is a 50% haircut in growth stocks. Like we said, the average leader tops and loses 72% off the high. Avoid that. CANSLIM isn't a buy and hold, buy the leaders and hold. It's a buy. Remember, William O'Neill took most of his profits, 20% from the pivot. He doesn't hold everything that he buys forever. There's a few handfuls of names that can give you massive returns of 100, 200, 300, or
like
4%.
NVIDIA, yeah.
For the most part, but for the most part, he's taking most of his gains, and this is part of the rule at 20% above the pivot.
Right.
So,
right. And listen, by the way,
that's the system. It's not an a la carte menu. That's the system. You don't have to choose rules to follow.
You can't pick it, right.
Follow them all.
Well, so here's the other thing, though. Along those lines, folks, similarly, put CANSLIM aside for the moment, because this is the heart of this whole discussion today. If you buy and hold and you do the asset allocation in the mutual funds, just like the 50-50 ETF, they've got to be fully invested at all times. So it's your job to know when to sell the fund, not the fund manager. He does not move to cash. He doesn't move 50% to cash when the market's getting scary. And then if we go into a bear market, he's moving 100% to cash. He's staying fully invested, writing it down. So I've told this story before, and I'm going to tell it again because it's important. This is back when I first, early in my career, it's like 96, 97, I'm sorry, it's 99, end of 99, early 2000. Right before the tech wreck, I was interviewing Art Bonell. He was the Bonell Growth Fund. He was a darling of Wall Street in the 90s. He had Dell, he had, the Dellionaires, he had Dell stock, he had WorldCom, which is now bankrupt. He had all these Cisco Systems was his big name. And so he was the darling of Wall Street. And during the commercial, he kind of leaned over me and said, "Man, Danny, I don't know what I'm doing. I got $40 million of new money the last 3 weeks." And I said, "Well, Art, that sounds like a good problem to have. What's the problem?" He said, "No, you don't understand. I've got to go invest that money right now at these prices." And I thought, wow, Art Bonell just told me that he actually thinks it's way too extended and he wouldn't be buying in his own portfolio. In fact, he's probably moving to cash in his own portfolio. But his Bonell Growth Fund has to be fully invested at all times. So he had to go buy $30 million of stock when he knew damn well, good and well, it was too high priced. So he was hamstrung by the structure of his fund. Almost all mutual funds and ETFs are like that. They have to be fully invested, all in, all the time, foot on the pedal with no brakes, and it's up to you to know when to sell. That's why if you have an advisor with the pie chart of mutual funds, you need to ask them, what is your sell discipline? If they tell you, well, it's an asset allocation, so you got some bonds, you got some stock, that's all good and well. Here's the problem with that diversification argument. You want enough diversification so one position like an Enron doesn't cream you because they're lying about the books and you had no way of knowing, right? On the way up. So in a good up market, a primary uptrend, you want to have enough diversification so that one position doesn't kill you. However, in a downtrend, in a bear market, all the correlations grow together and it sells off together. So everything goes down together. I don't want any of the crap. I want to move to cash. So in 2008, the S&P was down 42%, NASDAQ was down 50%, S&P was, small caps were down 60%, and I'm rounding. Emerging markets were down 70%. Even investment grade bonds were down 25, 30. Take your pick. You get a blended rate of down 40%. That's when you want cash or treasury bonds, maybe even gold. There's only a few asset classes you want when it hits the fan. You want to cover up. You don't want diversification. That's why Don calls it diversification. Okay? So you want enough diversification in a good market, and you don't want any in a down market. Is that what you've been told? Or have you been Pavlovian dogged by the traditional advisor brotherhood that is Wall Street? All right. Enough said. I've got off my bully pulpit. Go ahead, Don. Let's go to Team Revere.
Yeah, let's do it. And first, we're going to go to Ted. Ted's got. He's going to give us a quick summary on two perspective growth stocks that are in the 21 over 21 and had recent good reactions to earnings, and they're in kind of the sweet spot that hasn't gotten destroyed, which is data center components and data center networking. So Ted, take it away, and which stock you're going to show us first.
Yeah, here we go. So the first one is VRT, and I just want to quickly kind of introduce what a data center is. So as we progress as a civilization, we're more reliant on data than ever before. So these two companies are part of the backbone of the build out of data centers, central to this potential AI revolution. And so a data center essentially is a building or room that houses a bunch of computers that are connected to each other. And they kind of process information, data, they store it, and they distribute it to various applications. And so it takes a lot of power to operate these data centers. And if you imagine, like when you have a laptop on your lap, it gets pretty hot, right? And imagine like hundreds and thousands of big computers and gadgets hooked up to each other. That gets really hot. So VRT is the first ticker that Don has pulled up. Clearly, like the chart exploded on earnings, so something good is going on. And so first, I'm going to talk qualitatively about it and a few points on why might that be. And so Their products specifically are intricate in the power and cooling part of data centers, and they're central to the build out of these data centers. We need to cool these computers, or else they'll fry out, and everything, like if you have some computers frying out, then the entire system will go down. And so I read some reports on their website and also checked out their website. And so the first thing noted is that data centers are an above average growth market, and VRT, from their management, believes they're a leader in global supply in these facilities. They noted that their improved execution and organic growth in this last quarter improved their earnings outlook, which clearly reflects in the chart and the numbers, which I'll give later. So gapping up into all-time highs, if you can show the weekly chart, I think it's a better depiction of that. Yeah, so right there, gapped up into all-time highs, and even on this market correction, we're still very well above the 8 EMA, just oscillating around that level. So just clear strength, institutional demand in the stock. And so management also in their earnings report said that they think they're the 800-pound gorilla in the room, given its a leading position in thermal management, product development, investment in technology, scale, and ability to increase capacity. So, I mean, clearly management is confident, they're delivering, they have good numbers, and the chart is reflecting that. So some numbers quantitatively that I found in their earnings, they reported Wednesday, August 2nd on that big gap up at 46 cents a share, beating consensus estimates of 29 cents. This is a 360% year over year growth and is a 59% earnings surprise. And the stock, again, like I said, reacted very well to it. So this clearly shows institutions have demand for the stock. Sales reported at 1.73 billion, 7% more than the consensus estimate of 1.62 billion at 23.92% year over year growth. And so we currently have 4 quarters of earnings and sales acceleration, and next quarter earnings and sales are revised higher as well. I don't think Market Smith has the data for next quarter, but I've been testing out this Deep View charting service, and they have like 8 quarters of future estimates. So that's where I pulled that data from. And so again, from the earnings report, they noted that they had a record $4.8 billion of backlog in their products. So there's huge demand for their power and cooling systems. So that's pretty much it for VRT in that brief overview. They had a strong beat and raise quarter, and they guided higher, and their 2024 commentary was better than like what analysts expected. So the second company I want to briefly talk about is VICR. And so they specialize in power electronics. They design and manufacture high performance power conversion components, which also play into that data center theme, but also another like wide variety of industries as well, such as telecommunications, automotive, and industrial automation. And essentially, like what their products do is that they're able to convert power a lot more efficient than what we currently have, and that improves overall system performance and reliability. And this company is founder-led, which is definitely good because founders are generally more visionaries. They have passion for what they've created because like they started the company, obviously it's like their baby. So the founder's name is a PhD in physics named Patrizio Vinciarelli, who holds over 100 patents in this field. And I found that 2 of their earliest seed investors were also Nobel Prize winners in physics. So clearly we have 3 PhDs in invest in this company, 2 Nobel laureates. So this technology is definitely proven to work. DeepView Data says management also owns 30% of the business. So they clearly have skin in the game, which is kind of what we want to look for as an investor, because we want management to do what is best for the company. And if they have skin in the game, they also benefit from that. And so what sets Vicor apart and what makes them unique is that they combine, like their products have optionality. So they combine a bunch of various configurations in their applications, and they develop this modular approach, which allows flexibility and customizability from their customers to design and optimize various power solutions. Their product is referred to as high power density, which means they can fit in a bunch of power in a very, very small, compact form. And this is crucial for applications that have limited space, such as like nano semiconductors and things like that, data centers and portable electronic devices. And so by providing more efficient power conversion, Vicor helps reduce waste, heat generation, and overall operational costs for their customers. And so that's kind of what I have qualitatively about Vicor. And then just a few points quantitatively. The revenues for their second quarter ended June 30th, 2022 on that day, Don noted, and we clearly had a change in character, gapped out of this bottoming base. They reported 106.7 million, a 4.5% increase from 102.2 million from the corresponding period a year ago. And this was also a sequential increase from the 97.8 million in the first quarter of 2022. Their gross margins also increased to 55.2 million for the second quarter of 2022 compared to 46.8 million for the corresponding period a year ago, and increased sequentially from 46.5 million from the first quarter of 2022. Their net income, their earnings per share came in at 38 cents compared to 24 cents, which is definitely good results as well. So they believe that they also finally opened up a new factory in Massachusetts, and the founder, Vinciarelli, believes it'll generate over $1 billion of revenue yearly. So these are two prospective companies that we're looking into and potentially looking to buy once we've seen some stabilization in the general market and volatility and dampening in volatility.
And they've got something new. That's what drives the stock higher. It's not the chart. It's the story behind the company. We talk about that all the time in-house here at Revere. Great stuff, Ted. Nice dive, nice overview into two stocks that are very high on our watch list for, first of all, we need to get the market back into a positive tone before we can take advantage of these new names. Those are the two biggest letters to me in CANSLIM. So appreciate it, Ted. Thanks very much. Let's move on to Connor, who's got some sentiment. His topic is sentiment for this week, and whether or not that is helpful or harmful to what we're looking at as far as being bullish on the market. Connor, take it away.
Yeah, so today I wanted to go two different sentiment positioning tools that we use. They're clearly secondary to price, but they can provide valuable insight when analyzing the market. So the first indicator I'll go over is the AAII Investor Sentiment Survey. This is the American Association of Individual Investors, and this measures the percentage of individual investors who are bullish, bearish, and neutral in the stock market short term. And this is pulled from their website on a weekly basis. So this can be a good contrarian indicator because you want to see bearish sentiment greatly outweigh the bullish sentiment for bottoms and vice versa for tops. So as you can see from 7/19 to August 9th, bullish sentiment has been pretty high. The historical average is 37.5%. So on 7/19, we are well above the historical average for bullish sentiment. And yeah, the 1 year high was 51.4. So as you can see, the market had a short-term top right around when most people got bullish. So, and the time to buy was when there was virtually no bulls left, and bearish sentiment was well above average for weeks on end, and that's how the market bottomed. So this can be a good contrarian indicator. And if you're in a trending bull market, this isn't going to be as useful. But like we've seen recently, the bullish sentiment definitely grew, and the markets are pulling back after that. So these are just a good thing that we check in-house on a weekly basis, just to give us an idea of what are investors thinking, and think about the other side, because you always need to look at it, have a different viewpoint.
Excellent.
And so, yeah, if you want to go to the NAAIM. So this is the NAAIM. This is the National Association of Active Investment Managers. This is an indicator that tracks the average exposure to the equity markets among active investment managers. So by following this, we can get insights into what equity managers and fund managers are doing. So as you can see, August 7/26, the number of exposure was over 100%, and 7/27 is when the market actually topped. So you can say that that was a red flag and that was a signal. But basically, the numbers from looking at this that I've gauged from is that 10 to 20 readings can signal market bottoms. So that means virtually no active investment managers are in the market. 30 to 60 can signal market corrections. So last week it was 65.49. That was the average. And then anything over 85 can signal a market correction / top. So when you go back and look at this indicator, I believe when the whole stealth growth bear started, the number was well above 100. I forget the exact value, but this can just be another good thing to look at on a weekly basis to see what investors are feeling and how to gauge moving forward what the market could do. As always, we never predict. So these are always secondary indicators to price and volume, but nevertheless, they're good to follow and have an idea.
And it's a good thing to keep you from piling in at the top too. When you see sentiment is off the charts bullish, that means that one side of the boat is getting a bit crowded.
Well, yeah, it means everybody that was wanting to buy is already in. I mean, everybody's
Yep.
fully invested. When you got that real low bullish sentiment and it's down in the teens, that means there's a lot of cash on the sidelines to be ready to go to work. And if the market starts to rally just a little bit, all of a sudden people will start, FOMO will kick in and they'll start putting money in. So,
Yeah, this is the
Yeah,
historical chart that Connor was talking
Yeah.
about, and you can see how low things were at the bottom of the market. Good stuff. All right, appreciate that, Connor. Now Mike is going to follow up on something from the past and talk about something new. Mike, take it away.
All right, time for some fundamentals. So just going back to the well, speaking of the N, something that I wanted to mention, a few months ago, we had a mailbag question about weight loss drugs and the best way to play it. And Ted did I believe it was Ted who did a segment on it and highlighted the NVO LLY duopoly. And at the time, LLY and NVO were at highs, and it appeared the growth of weight loss drugs had been priced in. But surprise, surprise, what seems too high can always go higher. And this end now is starting to really catch on, and that is the application of these diabetes drugs for weight loss. And NVO is running out of supply because of this high demand, and LLY is right behind them with just increasing orders for their diabetes drugs that have this newfound purpose now of weight loss. So I just wanted to mention, yeah, what appears too high can keep going higher. And the two drugs, they're Wegovy and Ozempic, and they're diabetes treatments that are also used for weight loss, and they've exploded in popularity. And just some metrics on that: second quarter sales of Wegovy soared 537% to the equivalent of 1.1 billion. And as you can see, LOY on their earnings, massive gap up, adding tens of billions of dollars of market cap, and NVO as well, both of them sort of moving in tandem. So that duopoly of the weight loss drugs. And what's interesting too, some other positive effects we'll see long term. There's always, science is hard because there's always, it appears there's this miracle drug and then all of a sudden there's negative effects. So we'll see. But at the moment, it appears that these drugs also reduce the risk of suffering heart attacks, strokes, and cardiovascular deaths by 20%. And on that news, NVO gapped up 17%. So yeah, what appears too high, and these aren't just small growth stocks. These are, as you can see, the market cap $400 billion. So even though they're behemoths, they can on that end they can still run. So don't be dissuaded if the price looks too high, if there's a real catalyst there. And then something else I wanted to mention is going back to the theme of natural gas and my favorite name in that sector, LNG. So there's a report that natural gas has been jolted by Australian labor disputes. And for a while there, the price of natural gas has been just hitting low after low after low. But as natural gas tends to do, it just has spikes out of nowhere. It's very difficult to trade the commodity. And going back to what Dan said, if there's any commodity I would avoid trading, it's natural gas, because they call it the widowmaker. There's so many factors. There's weather, there's hedging, there's labor disputes, there's just a multitude of factors that the price on just out of nowhere, really. So that's something I would avoid playing. But something that you can play that I like a lot is ticker LNG, which is Cheniere, which is involved in the transportation of liquefied natural gas, which is pretty much detached from the actual price of natural gas, the way that their long-term contracts are set up. So with this, when investing, you never know what's going to happen, which is why it's so important to pick a company with the best management team and a history of executing in all market cycles. So looking at natural gas, there's the theme there. There's growing demand. There's growing demand all across the world, in Asia and Europe, especially in Europe, because of their past reliance on Russian LNG. Now they're scrambling, and they've secured new deals with Australian exporters, Qatari, and US exporters. So in terms of management, LNG, Cheniere, the CEO, Jack Fusco, their team there, they've really done an amazing job at executing across all market cycles. They have a history of being a really resilient and dependable, consistent supplier. So these partners that are securing long-term contracts, that's what they look for, and that's why when you're going to play a name in the space, I personally believe it's best to go with the best management team. So in terms of what's going on now, just to highlight the fundamentals as to the current situation, there's basically a dispute between workers and Australian natural gas companies. They're going on strike because they want higher pay. As we've seen, there's a lot of strikes recently. The auto workers union is also demanding higher pay. We've seen UPS, their contracts now going up to 170,000 a year in 5 years, which is pretty crazy. But the threat of disruptions is really worrisome for Europe, because we are in the summer months now, but they're preparing for their storage and supplies for the winter. And they kind of got bailed out last year on this warmer winter than expected. But based on the weather patterns currently and the way things are headed, it's been raining a lot. It's actually pretty cold there this summer, and they're expected to have a pretty cold winter. So if that's the case, they really got to secure those contracts and supplies now. And that drop in LNG exports, potential drop from Australian suppliers, could push European and Asian buyers into a bidding war for gas from elsewhere, including the US. So the best place to be, in my opinion, for that is LNG. And we'll see what's happening. But the chart is confirming that, if you can see the relative strength there after bottoming out, it's just been going higher and higher. They had earnings. I can get into the earnings next week if we're interested in going through the fundamentals specifically of LNG. But that's the place to be. And yeah, price action's confirming. So like LNG a lot.
Awesome. Thanks, Mike. Appreciate it. Dan, before I take it back to you, I'm just going to give a very quick overview on the key levels that we're looking at in the overall market. And the key level obviously is holding this 50-day moving average on the S&P 500. We're watching that closely. We are getting a break of the 50-day moving average on the NASDAQ 100, and that's certainly not beneficial to the overall market because of the large tech component in NASDAQ 100. Also corresponds to the big tech component in the S&P 500, which is made up of the big three spider sectors: XLC, which is communications, XLK, obviously, which is tech. And this one looks so bad because of the reaction to Apple and Microsoft, which make up about 40% of this since their earnings report, and XLY, consumer discretionary. Tesla and Amazon are the two biggies in here. And that's holding the 50-day moving average from now. But the relative strength of those three has been waning. And because there's such a big component in the S&P, that's going to act like an anchor, and not an anchor in a good way. Dan, that will
sink your ship, will it?
Yeah, or keep your ship from making any progress. So
Yep.
Back to you. You can wrap it up for the week, Dan.
All right, folks. Listen, if you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. They can just go up to the right-hand corner. There's a subscribe button. They can put their name and email address in. We're not going to reach out to them or spam them in any way. It's up to them to reach out to us. By the way, next to the subscribe button is a contact button. It'll send an email directly to me, and you can ask about a complimentary portfolio review, a topic you'd like discussed, or simply asking about a specific stock or two. Ton puts out, we do a daily market insight. It's called Tomorrow's Insights. It's a daily market insight video Don does every night the market is open for about 20 minutes. And then you get this podcast delivered into your inbox every Saturday morning when it goes out. But if you sign up for our YouTube channel, just go to YouTube and just type in Revere Asset, just Revere Asset, and hit subscribe. You'll get this as soon as Zach posts it on the air. Right now, it is what? It's actually 11:50 Central Time. He'll probably have it up there within an hour on YouTube. So about 1 Central Time, it'll be up there before the market closes if you really want our content. And we've also got some teaching, educational videos and some shorts. We've got a lot of research that's free that talks about relative strength or Fibonacci or moving averages, sell rules, buy, all kinds of stuff. Anyway, you can also email any of us, Dan@RevereAsset.com, Don@RevereAsset.com, or Michael, Ted, or Connor at RevereAsset.com. And you can always call us old school at 855-REAL-WEALTH. We'll talk to you next week on Your Money.
Because it's not about how much you can make in the market, it's how much of that you can keep.